China is struggling to build on a record of expansion based on investment and exports by reorienting its economy towards domestic demand. Like that troublesome second album, it's not going smoothly, though. By shying away from fundamental reforms, the authorities are leaving themselves dependent on a traditional toolkit of fiscal expansion, credit growth, and moral suasion to keep growth close to target. This toolkit is approaching the end of its shelf life, leaving risks of slower growth and perhaps even a hard landing. I'm joined once again to discuss these highlights of the global outlook by Mike Jakeman from our global forecasting team. Mike, we've brought down our forecast for China. By how much, why, and why now?
Well, I think you gave a very good summary of why we've done it in your introduction. We've reduced particularly our medium-term outlook for China, so for years 2018, 2019 and 2020. We now think by the end of this decade, China is going to be growing at a little more than 4%, which of course is a whole huge difference from where China was even 5 years ago. The idea that China growing at 4% would sound catastrophic for the global economy. It is a problem, and we'll talk about why in a minute, but I will say that China by 2020 is going to be a much larger economy than it was, let's say, in 2007. So growth of 4% still represents a huge amount of new output coming into the global economy. As for why we've taken it down, well, the biggest reason is debt. Credit growth in China has been growing rapidly. At the end of last year, the beginning of this year, something like 4 times the rate of nominal GDP growth. And you get to a point where the numbers don't lie, and you've got so much new lending going on that it just looks unsustainable. You can't imagine this is going to keep going on for 5 or 6 years without any kind of consequence. So I think this became a slight issue for us that we need to actually show what's going to happen here. And we think that the government is going to be forced to intervene to slow the rate of credit growth, perhaps as soon as the end of this year. And that's going to have a cooling effect on the rate of growth, assuming that it does it well.
Okay. You've mentioned China's gravitation in the global picture. So let's move away from China for a moment and just look at the impact of a slower China forecast for other areas of the world, other countries, commodities, other markets.
Yeah, as we've said before, China is now the most important cog in global supply chains. So a slower China, even if it's just a few tenths of a percentage point here and there, has ripple effects around the whole world. And I think everybody is very nervous about the way in which the Chinese government is going to manage this. Some effects we're already seeing in our forecasts. We've cut forecasts for prices for a huge range of industrial metals. For things like aluminium and copper, China accounts for half of the global market. So a small change in Chinese demand has a big effect on the amount of metals that are being refined and the amount that are being dug up, and then the prices that these range on the market. So that has particular negative effects for big commodity exporters. So countries like Indonesia and Australia would be two that we will probably bring down as a result of this. I think if you're looking at economies that service the Chinese consumer market, so places like Taiwan and South Korea, are probably slightly better insulated. Within China, this is a change that's focused on the industrial sector. The Chinese consumer sector and the services sector are still growing quite rapidly off the back of good real wage growth. So Chinese consumers are going to continue to buy all the kind of middle class goods and services that middle classes in all emerging markets want to buy. So those countries should be a bit more insulated. But in general, this is a kind of a negative move for the global economy. We've got the US expected to be in a business cycle recession in 2019. We've made that a bit deeper this month. And I think 2019 as a whole is going to be a softer year for the global economy. Just as the business cycle ends, the Chinese slowdown continues. So lower sentiment in general in the second half of the forecast period.
Okay, I'm struck by the fact. Maybe this is even more concerning than the lower trajectory of Chinese growth that we're forecasting. We've now raised our forecast for the probability of a hard landing in China. Yeah. We're now saying around 40%. Now, it's important to note that doesn't equate to a forecast of a hard landing, but it's about as close as you can get without actually moving it over to saying, on balance, we expect a hard landing. So tell me a little bit about what a hard landing means, what it would look like, and what the impact would be on China and on the global outlook.
Well, we need to be really clear about our terminology here, because lots of people would look at a forecast of China growing at 4.3% in 2020 and say, well, that is a hard landing. We don't think it is. We think that's probably more of a kind of bumpy landing. And those are the choices that are facing the Chinese economy now. A kind of bumpy landing towards this kind of consumer-focused growth, or a hard landing where you get a major crisis. So we define a hard landing as growth in any 1 year that is 1.5 percentage points below our forecast. So for this year, in 2016, we think China's going to grow about 6.5%. So a hard landing would be if growth came in at 5% or slower. Likewise, take it out to the end of the forecast period, and we'd be looking at if you had growth of 2% in a year, that would be a hard landing. What might cause a hard landing? Well, it would be a bigger bang than we've seen so far. So not just volatility, but an actual crisis. It could come through the property market, or it could come through a bad debt crisis in the banking sector. And I guess the kind of upside risk to a hard landing, if you follow me, is that if the government is forced into serious policy action very quickly, and has to have a sort of short, sharp shock, you might then get growth rebounding and continuing at a slightly higher rate than if you allow this debt accumulation to continue, the amount of loss-making zombie firms in the economy to continue to totter around. So we think there's a very high risk of a hard landing. It could easily happen. It's not quite our central forecast yet, although for every month that credit growth continues to grow at the rate that it is, that risk probably rises slightly. But I also want to stress that if we did have a hard landing, it wouldn't necessarily be ultimately a worse outcome than if you get sort of the continued ongoing slowdown cluttered by unprofitable firms. So there's lots of different ways in which this could materialise. At the moment, we're going for a bumpy landing, but there is a very high risk that it could be shorter, sharper, and more painful in the short term.
Good. So we have this picture of a Chinese slowdown, which we'd already factored in. We're now expecting it to be a little more powerful than we'd thought.
Yep.
At the same time, there's a lot of attention at the moment being focused on India, which is being seen in many ways as the new exciting growth market. And we have growth there at 7.5% this year, which is pretty good. It's the fastest growing economy in the world. I've just come back from India, and it certainly feels like a place that's on the move. What do you think about the outlook for India? Is 7.5 enough, considering the global conditions that India finds itself in?
I would say that India's almost by default become the kind of shining emerging market star in recent months, because people still look at BRICS as an acronym, and you see recessions in Brazil and China, and a lot of instability in China, and therefore India at 7.5% is kind of the best prospect by default. 7.5% is much better than India was doing a couple of years ago, when they had some fairly poor leadership, both of the government and at the central bank. And they had a structural problem with inflation and a couple of poor harvests, and growth was around 5%, which for India is very, very poor. Since then, I would say that global conditions have really favoured India. We've got very cheap energy prices. Our food and agricultural commodities index has fallen, or is falling, for the 5th year in a row. That's obviously extremely important for India. And as a result, they've been able to keep interest rates lower for longer. So, if India was ever going to grow very quickly, you would imagine now is the time. It's a kind of sweet spot for India to capitalise on. I'm not sure that Narendra Modi's government has done quite enough yet to say that it has responded to those conditions in quite the right way. It's really been hobbled in its bid to get through pieces of landmark legislation, such as this unified goods and services tax, by the fact that it doesn't have a majority in the upper house of parliament, so it's forever having to make compromises. I think this is really a sort of critical period for Modi. Imagine in a couple of years' time, when inflation is higher because energy prices are higher and he's facing re-election, this is the period when he'll want to look back and say, yes, but we did these 3 or 4 major pieces of legislation. So I think there are reasons to be a little bit cautious on India. It is not growing at the rate that it was growing before the financial crisis, when it was routinely doing 9 and 10% a year, which I think is a problem given the external conditions. However, no one is doing that rate either, so perhaps I'm being a bit harsh. And we should say that India is, given the size of the economy, this is a major plus point for the global economy that India is doing at least relatively well. But I'm intrigued that you felt that the atmosphere is good on the streets.
Well, it's very very striking. So you used to the Chinese spectacle of seeing entire cities raised from the ground in a few months. So there's a bit of that in India. There's a lot of road building and there's a lot of activity everywhere. But also just down on the street, that sense of popular entrepreneurialism that is really making the place feel as if it's in ferment. And the general the visibility of middle class consumption in parts of the cities that you didn't previously see. That your expectations of what you were going to see were completely different. So it's moving, but it has also moved on. It's a different place now from what it was 5 years ago. And let me put it this way: if India doesn't sustain its growth path, then I would be quite concerned that there's an expectation built up. The population that's there now is not the same as the one that was there 10 years ago.
No, and it is about to hit its sort of demographic dividend. So now is the time to create those jobs and to make sure that sustained rate of 7.5% is the minimum.
Yeah. Okay, so it's one for us to watch, and for sure we'll be coming back to it. Before we close, I think we need to touch on events in Brussels. Horrifying events, and apart from anything else, they demonstrate that no matter how hard you try, if people are determined enough and have little enough respect for their own and other people's lives, they will always get through. But our job is to try and analyse here the broader impact on the business environment, on the economic environment, how we expect this to play. Does it change in any way? Does it surprise us? Does it change our view of what's coming up?
No, I don't think it does surprise us. These events are shocking, but we've seen enough of them in recent months not to be surprised by them anymore, sadly. I think in terms of Belgium, there'll be sort of small negative effects on consumer and business confidence. Country's shaken, obviously. We're going to see some serious questions asked about the security capabilities, I think, because this obviously has happened in the light of the Paris attacks in November, which already saw security risk raised, and the amount of money that's being spent on security forces has increased. It'll increase further, but the fact that this was allowed to happen, or the fact this did happen, is a worry for the whole region. We should see some improved communication between the different parts of not only the Belgian authorities but across the whole EU, which should be a positive, albeit some people will say this should have happened a bit sooner. And it will still, it will unfortunately feed into these continuing questions about, the purpose and the effectiveness of the EU, and not, also of course in the UK. I mean, sadly, this is going to be picked up as part of the Brexit debate. It, already has done even a day after the tragedy, and this will be used as evidence that perhaps the UK is not safer within the EU. I mean, I think we dispute that, but it will still be another sort of plank to that argument. This is a negative development for the Eurozone, and a very tragic one. Yeah,
and the EU, that move towards a more isolationist, populist politics, if you like, we're seeing it obviously not just in the EU and Britain, but further afield to do. Thank you very much, Mike. Thank you for joining us.